What's up guys, and welcome back to Wall Street Millennial. On this channel, we cover everything related to stocks and investing. The market crash of 2022 has hit technology stocks particularly hard. Of the tech billionaires, the single hardest hit has been Facebook founder Mark Zuckerberg, whose net worth has declined from $135 billion a year ago to just $50 billion today. The share price of Facebook parent company Meta has cratered in recent months. As of the time of recording this video, it is now below its level from March of 2020 during the depths of the pandemic. Meta is facing a number of challenges, which many commentators are now calling an existential risk for the company. It's hard to imagine Facebook going away. With 3 billion monthly active users around the world, it has become ingrained into the average person's day-to-day life for the better part of the last decade. But it's important to remember that in 2008, MySpace looked like an unstoppable force with over 100 million unique users. For decades, Sears dominated the retail landscape. If you asked people in the 80s or 90s, none of them would ever guess that such a great company could ever go bankrupt. And now, both of those companies no longer exist. The point is, just because a company is massive today, doesn't mean that it will still exist 5 or 10 years from now. With their revenue and profits taking a nosedive, many investors fear that Meta will face a similar fate. In this video, we'll look at what's going on with Meta's stock, and whether we could see this once great company go bankrupt within our lifetimes. This video is brought to you by Vessi, a revolutionary new type of sneaker that'll change your shoe life. Vessi shoes are 100% waterproof, not water resistant. It doesn't matter how hard it's raining or how many puddles you step in, your socks will be dry when you come home. I was skeptical at first, but they sent me a pair of their men's everyday classic model to try out. I decided to put them to the test. As you can see, I tried to drench them with a garden hose, but my feet didn't feel a thing. My socks showed no signs of wet marks anywhere. If you still don't believe me, take a look at what happens to these tissues I put inside the shoes. I tried to soak them through the Vessis from all angles, but when I pulled the tissues back out, they were bone dry. I could honestly still have used them to blow my nose. But what really seals the deal for the Vessis is that they're actually extremely comfortable, lightweight, and breathable. They're made from a material called Dymatex, which is both waterproof and breathable. Because they're so versatile, they're a great pair of shoes to wear all year round and for all occasions, from working out to going to work. Vessis are now my go-to shoes by my door. Check them out in the link below, and remember to use my discount code for $25 off your very own pair of Vessi shoes. And now back to the video. By this point, most of you are likely already familiar with Facebook, so we won't go into too much detail on the company's history. It was founded in the early 2000s by Mark Zuckerberg in his Harvard dorm room. The company grew very quickly, and by the early 2010s, it had become the dominant social media platform in the world. They benefited from the so-called network effect. If all of your friends are already on Facebook, you have to get a Facebook account yourself, otherwise you'll feel left out. Because of this network effect, they were able to grow their number of monthly active users exponentially from 100 million in 2008 to almost 3 billion by 2020. One of Zuckerberg's best strategic moves was acquiring Instagram for $1 billion. At the time, it was viewed by many investors as a waste of money, as Instagram was still burning cash. But Facebook was able to prove the skeptics wrong very quickly. By integrating Instagram with Facebook, user growth exploded, and it now has over 1 billion monthly active users. This also had the benefit of taking out a potential competitor and cementing Facebook's position as the global social media monopoly. Since Facebook and Instagram are free to use, they generate revenue by showing advertisements to users. Besides their massive scale, another advantage that Facebook has is their state-of-the-art advertising technology. They employ thousands of talented engineers tasked with optimizing their advertising systems. They collect huge amounts of data from all of their users. For example, they know who all of your friends are, which Facebook groups you follow, which types of posts you engage with, etc. As a purely hypothetical example, if you follow a lot of pregnancy-related groups, they may assume you are a pregnant woman and show you ads for baby-related products. If you follow video game-related groups, they might show you ads for gaming PCs or similar accessories. Because the ads are so well targeted, the chances of you clicking on it and buying the product are very high. This lets them charge very high rates to the advertisers. Because of this, Meta has the highest average revenue per user of all major social media companies. In 2021, they made $41 per user compared to about $13 for Snapchat, $7 for Twitter, and $6 for Pinterest. Facebook's massive scale combined with their advertising efficiency contributed to skyrocketing revenue and profitability. They benefited tremendously from the pandemic. Facebook usage increased as people wanted to connect with their friends and families from the safety of their homes. In 2020, they made a record $29 billion of net profit. In 2021, they smashed the previous record with $39 billion. They were making so much money that Zuckerberg decided the company could afford to spend $10 billion per year for the next decades to create his vision of the Metaverse. They even went so far as to change their corporate name from Facebook to Meta. Given what a strong position they appeared to be in 2021, what caused their share price to decline by almost 2/3 over the course of the last 12 months? Meta is facing 4 main problems, which taken together could represent an existential risk to the company. The first is an industry-wide decrease in ad spending as a result of the Federal Reserve's rate hikes and much anticipated recession. The second is privacy regulations from Apple, which make it more difficult to target advertising. The third is the massive cash burn from their Metaverse investments, which is increasingly looking like a waste of money. And finally, a competition from TikTok, which is probably the most concerning. As for the Apple privacy changes, we've already released a video about this here, so I don't want to repeat too much. The main point is that Apple's recent iOS update makes it much more difficult for Facebook to track users between apps. This makes it harder for them to target advertisements and cost them about $10 billion per year in lost revenue. This alone wouldn't be an existential crisis because they made almost $40 billion of net profit in 2021. So even if they lose $10 billion, it's not the end of the world. And no matter what hurdles Apple throws in front of them, their armies of software engineers should eventually be able to find a way around this eventually. Another problem is a general decrease in advertising spending. With the Fed increasing interest rates, most economists are now predicting a recession, and many companies are pulling back their ad budgets to conserve cash. In 2020 and 2021, a lot of new tech startups invested heavily in digital marketing to fuel their growth. They relied heavily on issuing new stock to fund their ad spend and general cash burn. With the DSPC SPAC index down 75% over the past year, the ability of these hyper-growth startups to fund their ad budgets has decreased substantially. The current recession will end eventually, but one thing that's not going away anytime soon is TikTok. Over the past few years, the short-form video platform has taken the world by storm, with over 1 billion unique users. TikTok competes directly with Facebook for eyeballs. It's not uncommon for the younger generations to spend 5 or more hours per day watching TikTok videos. There are only 24 hours in the day, so this will inevitably decrease their time spent on Facebook and Instagram. We know that Zuckerberg has been scared of TikTok's competitive threat since at least 2018, when he launched the Lasso video sharing app, which is almost an exact clone of TikTok. In 2019, The Verge obtained leaked audio from an internal Facebook meeting, where Zuckerberg talked to his employees about Lasso.
Called Lasso, that's a standalone app that we're working on trying to get product market fit in countries like Mexico is I think one of the first initial ones. So we're trying to first see if we can get it to work in countries where TikTok is not already big, or we go and compete with TikTok in countries where they are big.
Unfortunately, they were already too late. Even in places like Mexico, where TikTok was slower to catch on, Lasso was a complete failure, and they shut the whole thing down in 2020. They decided that instead of creating their own standalone TikTok competitor, they would integrate a short-form video platform onto Instagram. They called this Instagram Reels, and it has almost identical functionality as TikTok. Instagram already has a user base of 1 billion strong. By leveraging this captive audience, Zuckerberg and co. thought they had a foolproof plan to crush TikTok and take back their position as the dominant social media monopoly. Facebook had previously given very little disclosure about the performance of Reels, so investors were left guessing as to its success or failure. That is, until a leaked internal document was reported by the media in September of this year. The average daily time spent on TikTok is almost 200 million hours per day. Instagram Reels time spent is just 17.6 million hours, less than 1/10 of TikTok. Furthermore, of the 11 million people who create Reels, only about 20% of them post at least once per month. And to make matters even worse, 1/3 of videos on Reels were originally created for TikTok and just re-uploaded to Reels. This suggests that TikTok is still the dominant short-form video platform by far, with Reels being little more than an afterthought. Increasing competition from TikTok has not yet shown up in Facebook's user numbers. Between Facebook, Instagram, Messenger, and WhatsApp, they have roughly 3 billion monthly active users. This has stagnated in recent years, but that's because just about everyone who could use Facebook is already using it. There are 7 billion people in the world, but many people live in rural areas without access to the internet. There are only about 5 billion internet users in the world. Another 1 billion internet users live in China, which does not allow any of Facebook's apps. So of the internet users that could use Facebook, 3/4 of them already do. When you get to such a high penetration rate globally, it's very difficult to continue growing the user base. While TikTok is not decreasing the number of users on Facebook, it is decreasing time spent per user. The less time that you spend on Facebook, the less ads they can show you and the less revenue they can generate. This, combined with lower targeting efficiency due to Apple's privacy changes, have caused revenue growth to turn negative in the second quarter of 2022. This is the first negative quarterly growth rate they've reported since they became a public company in 2012. However, it was only a 1% decline, so not exactly catastrophic. The profitability picture looks a lot worse. Net income has been on a consistent downward trend since 2020, declining from more than $10 billion per quarter to less than $7 billion in the most recent quarter. The main culprit behind the decline in profitability is Zuckerberg's Metaverse ambitions. In 2021, Meta announced plans to invest $10 billion per year every year for the next decade to build out the Metaverse. Zuckerberg has a vision where people will do everything in their daily lives virtually, everything from going to work, hanging out with friends, and fitness exercises. They've been planning the Metaverse expansion since 2014, when they acquired the VR headset maker Oculus. Their goal is to use Oculus as a key enabler of the Metaverse, starting first with video games and gradually expanding into other Metaverse use cases. All of Meta's Metaverse-related projects, including the Oculus, sit within their Reality Labs segment. Reality Labs has seen impressive revenue growth with over $2 billion of revenue in 2021, driven mostly by Oculus sales. Oculus is the single best-selling VR headset in the world, with an estimated 29% market share. However, this represents less than 2% of their advertising revenue, so it's not enough to move the needle on a consolidated basis. What's more concerning is the operating losses of Reality Labs, which exploded to more than $10 billion in 2021. They're investing heavily in developing software to achieve Zuckerberg's ultimate vision of creating the real world in virtual reality. When they rebranded to Meta in 2021, he made an elaborate promotional video showing him entering into a visually pleasing virtual world. But it's important to note that this is just a green screen CGI rendering of what they think the metaverse could look like in 10 years. Today, they are nowhere close to this level of quality. At the moment, their flagship game Horizon Worlds has graphics that look like they came from the 1990s. They're roughly on par with Halo Combat Evolved, which came out in 2001. The problem is, Facebook is a social media company, not a video game company. This forces them to build everything from scratch, which will be very costly and time-consuming. The best option would be for them to acquire a large video game company that already has this expertise. But given the current political environment, this would be all but impossible. Lawmakers in both the US and Europe view Facebook as already being too powerful because of Cambridge Analytica and other privacy scandals. The Federal Trade Commission recently sued Meta to halt their acquisition of a tiny app developer, as they said this would be anti-competitive. So growth through acquisition is off the table. They now have no choice but to develop everything in-house, which, as we've already seen, is very expensive. Do all these problems spell the end for Meta? As of the time of recording this video, its share price is below the low point from March of 2020 during the depths of the pandemic. Of the problems they are facing, the TikTok competition piece is the only one that could be considered as existential. As long as people continue to use Facebook's apps, they'll find a way to monetize it. My personal view is that TikTok will never completely replace Facebook. On TikTok, people mostly view videos made by random creators around the world. Facebook and Instagram are still the only places where you can stay connected with your friends and family by seeing what they're up to. This is something that TikTok can't replace. That's why we see the number of monthly active users staying steady at around 3 billion, even though the time spent is likely decreasing. And despite the headwinds Meta is facing now, there are still some levers that they can pull to increase profitability. In recent years, they've gone on a hiring spree, increasing their number of full-time employees from 13,000 in 2015 to more than 70,000 today. A lot of these people are working on the Metaverse, which by Zuckerberg's own admission won't be profitable until the end of the decade at least. There are already reports that Meta is planning to lay off as much as 10% of their workforce over the coming months, as part of a broad cost-cutting initiative. Reducing their workforce will help them to remain profitable, even as their revenue growth stagnates. With the rise of TikTok, Facebook may never reclaim its throne as the world's social media monopoly. But it's still too early to count the Zuckerberg out just yet. Alright guys, that wraps it up for this video. What do you think about Meta? Let us know in the comments section below. As always, thank you so much for watching, and we'll see you in the next one. Wall Street Millennial, signing out.